Welcome to IUL University. In this series of short, easy-to-follow training modules, you will learn all about indexed universal life insurance, who it is for, and how you can best position for your clients. These sessions are designed to be viewed on your own time and only take a few minutes each. In this lesson, we will provide a quick overview of universal life insurance. You will then learn how accumulation universal life insurance works and get a quick lesson in the 3 available types of accumulation UL policies. Universal life insurance is a form of permanent life insurance coverage that allows for flexible premium payments. It can provide cash value accumulation potential or a guaranteed death benefit and may include additional riders or coverages. There are 2 common types of universal life policies in the industry, guaranteed and accumulation, sometimes also called current assumption policies. For this lesson, we will be focusing on the accumulation policies. We will be covering GUL products in the lesson titled GUL versus IUL. The basic difference between guaranteed and accumulation products is protection versus cash accumulation. Guaranteed universal life offers a guaranteed death benefit, but little to no potential for cash value accumulation. On the other side, accumulation universal life products are designed to grow cash values that can be used during the policyholder's lifetime. Accumulation universal life policies have the potential to grow cash values tax deferred, which can be accessed by the policy owner through loans or withdrawals. Their flexibility allows the client to change their premium payments and death benefits. Under the terms of the policy, the excess of premium payments above the current cost of insurance is credited to the cash value of the policy. The cash value is credited each month with interest, and the policy is debited each month by a cost of insurance charge, as well as any other policy charges and fees which are drawn from the cash value, even if no premium payment is made that month. Interest credited to the account is determined by the insurer, but has a contractual minimum rate, often 2%. There are 3 types of accumulation life insurance products, which differ by how the interest is credited to the account. These are interest-based universal life, which provides a stated or fixed interest rate. Indexed universal life, in which the interest is linked to the performance of a specified index. Variable universal life, which is tied to investment accounts. Interest-based universal life insurance grows the cash value through a set of interest rate that is specified by the insurance company. These rates are subject to guaranteed minimums, which are generally between 2 and 3%. Of the 3 accumulation UL options, interest-based ULs offer the lowest variability of returns. With indexed universal life, or IUL, the interest is linked to the performance of an underlying index, such as the S&P 500. The interest earned is subject to caps and floors and is calculated and credited during a specified time period, often 12 months. When paying monthly premiums, each month's payment will be given its own individual calculation. Therefore, the policyholder may have 12 separate rolling annual crediting periods earning interest. The returns on an IUL are generally mid-level, and because the floor is generally set at 0%, there is no downside risk. Indexed universal life policies are growing more popular in the universal life marketplace. Variable universal life, or VUL, allows the policy's cash value to be directed into sub-accounts that operate similar to mutual funds. These sub-accounts can be tied to stocks or bonds, which may provide higher potential for growth, but greater risk since there is no downside protection included through a floor rate. In addition, there are certain producer licensing requirements to sell this kind of product. Please note, United of Omaha does not offer a variable UL policy. Let's test your knowledge based on what you've learned in this lesson. Which of these accumulation products offers mid-level returns with no downside risk? A. Interest-based universal life. B. Variable universal life. C. Indexed universal life. Or D. All of the above. The correct answer is C, indexed universal life. Which of these is not a type of accumulation universal life insurance? A, interest-based UL, B, variable UL, C, indexed UL, or D, guaranteed UL? The correct answer is D, guaranteed universal life. In this lesson, you've learned about universal life insurance, how accumulation universal life insurance works, and the 3 types of accumulation policies available.